Buckle up as we navigate the stormy waters of the recent dramatic changes in interest rates and inflation. The central banks globally are in the driver's seat, and they've been pushing the accelerator on interest rates. Take the Federal Reserve, for instance. They've hiked their benchmark interest rate for the 7th time in a row. That's not a small wave, folks. That's a 15-year high tide. And why is this happening, you ask? Well, it's a battle against a formidable foe: high inflation. It's like a sea monster that devours the purchasing power of your hard-earned money. And the central banks, well, they're the captains trying to slay this beast. So, we might see this trend of rising interest rates continue. Now, this rising tide doesn't just affect the big ships, it rocks the small boats too. Take credit card debt, for instance. As interest rates rise, the cost of borrowing increases, but don't worry, there are lifeboats available. Transferring balances to a zero-rate balance transfer card or securing a low fixed-rate personal loan are feasible options. Then there's the swell in mortgage rates. Homeowners, especially those with variable-rate home equity lines of credit, are feeling the impact. Some are considering fixing the rate or paying off the balance with a lower promotional rate, HELOC. So, as we sail through these turbulent waters, remember, every wave, every ripple in the interest rates and inflation has far-reaching effects. The financial landscape is shifting, and the tremors can be felt in every corner of the economy. As the dust settles, we find ourselves amidst fading inflation and interest rate shocks. But what does this mean for the future? Well, let's dive into this fascinating economic landscape. We are witnessing a decrease in inflation and a decline in the number of central banks hiking rates. This decline, as discussed in a recent Seeking Alpha article, suggests that the drag from surging interest rates on economic activity may be hitting its peak. So, what's next? It's possible we may see new lows in economic activity in the upcoming months. This isn't necessarily a cause for alarm, but rather a reflection of the ebb and flow of economic cycles. Central banks may even start to cut rates next year, a move that would signal a shift in economic strategy. Speaking of shifts, it's worth noting that we seem to be transitioning to a more inflationary equilibrium. This is driven by several factors, including fiscal policy, geopolitics, and labor markets. It's a complex balance, and central banks are dancing on a tightrope as they navigate these changes. Fiscal policy, for instance, has been pushing up inflation. Government spending has been high, and this has been pumping money into the economy, raising prices. Geopolitics has also played a role. Tensions and uncertainties in the global political landscape can contribute to inflationary pressures. And let's not forget the labor markets. Worker shortages and rising wages are also pushing up costs and consequently inflation. However, it's not all doom and gloom. Central banks have a choice to make. They can either retighten their fiscal policy, potentially slowing economic growth, or they can allow for some inflation as economic growth rebounds. It's a delicate balance, and the decisions made will undoubtedly shape the economic landscape of the future. The pendulum of economic activity is swinging, and we're waiting to see where it will finally rest. The fight against inflation is on, and the gloves are off. In a world where the cost of living seems to be perpetually on the rise, the Federal Reserve has made an aggressive move in an attempt to combat inflation, delivering the largest rate hike we've seen since 1994. This bold action is not without consequence, as it's set to impact American businesses and households alike by increasing borrowing costs. The stock market, however, has responded positively to this announcement, a clear testament to the faith investors place in these aggressive measures. This reaction underscores the market's interpretation of the Fed's commitment to reducing inflation. But this isn't a one-off jab at the inflation monster. The Federal Reserve has indicated that future rate hikes may very well be on the table. This suggests that we could be seeing more of these aggressive moves in the effort to manage inflation. The goal, as stated by the Fed, is to return inflation to its 2% objective. Yet, we must bear in mind that these measures, while necessary, are not without their own set of repercussions. As the cost of borrowing rises, businesses and households could feel the pinch. But in the grand scheme of things, these measures are designed to bring about long-term stability and sustainable economic growth. In the battle against inflation, it seems the Federal Reserve is pulling no punches. As we navigate these economic tides, it's crucial to stay informed and understand the implications of these macroeconomic decisions on our everyday lives. After all, knowledge is the best defense in any battle.